And here we are today, we're going to cover this very interesting topic on business combinations. This is one of the areas where accounting has changed dramatically. And we will see as we go through these slides that today what we do under amalgamations under AS 14 or under the Indian requirements, that landscape has dramatically shifted. Okay. Without getting into much ado, we'll just get into the topics into what we want to cover today. We will talk about what is a business. When we talk about business combinations, what do we mean by the definition of business? We'll cover that. We'll talk about the acquisition method of accounting. What does that require us to do? What are the principles, acquirer, and variety of other things that we'll cover from a part of acquisition accounting. We will talk about acquisition in stages. How do you deal when you do acquisition in stages? And Jigar touched upon the topic on common control transactions. What do you do when there's a common control transaction acquisition? How does that get dealt with? And disclosures and differences with the current Indian GAAP. So that's the broad kind of an agenda that we have for this topic. Please do interrupt and ask questions. Let's try and make this more interactive because this is a very interesting topic. As you'll see, some dramatic changes that will come through. Okay. So firstly, when we get into any standard, first we need to decide what is the landscape the standard is covering. So what is the scope of the standard? What transactions will get covered in the standard? Okay. So the standard 103 applies to a transaction or events that meets the definition of a business. What is a business? We'll talk in the next slide. But there are certain scope exceptions. So for instance, if you're forming joint ventures, then that is scoped out of the standard. There's a separate standard to deal with formation of joint ventures. Similarly, if it's an asset acquisition, not covered, separate standard which talks about asset acquisition. When we talk about combination of entities under common control, again it has been scoped out, it's covered as a part of the appendix. Now this is an interesting area where IFRS has actually just scoped out common control transaction. Ind As, so under IFRS there is no guidance. How do you account for common control transaction? Because it is scoped out of business acquisitions. While under Ind As, the appendix clarifies that how you should account for common control transactions. So in a way, Ind As lays the landscape that what you need to do for common control transactions, IFRS is a bit silent about it. And we will get to it in a detail when we go there. So these are the three aspects. If they occur, they are not a part of business combination accounting. Okay. Okay, now moving on to what is business combination. What are the important aspects that we need to be aware of when we talk about business combination? So business combination is a transaction or event in which acquirer obtains control over one or more businesses. So friends, the important part here is the definition of control. And that we will deal more detail when we go to the consolidation standard, because again, the definition has gone a dramatic change. Today, when we look at control from an Indian GAAP, what would we look at? When would you say it is control? Any idea? Any thoughts? When would we say an entity controls this entity? Boarding power, control over board, or 51% equity. These are the two things, if you are there, you will say a company has control. This has changed now. Voting power is no more a determinant of control. Okay? In fact, even if you have 40%, there could be a situation you may land up consolidating the other company. And we'll deal much more detail in the consolidation standard. So I will not get into it, but if you see the way the control definition is structured, it is not talking about 51%, it is not talking about control of the board. It is talking about power over the investee, exposure or rights to variable returns, ability to use the power over the investee to affect amount of investor returns. We'll deal, as I said, I won't get too much because there's a detailed discussion we are going to have on consolidation. But just remember the definition of control has changed. So first, what is a business combination? In a business combination, the acquirer has to get control. That is a prerequisite. The definition of control is no more equity linked. It is defined as power to govern, power over the investee. And we will see what that means. Now, having said that, what is a business? We've talked about business combination, right? So what is a business? When we say how is the definition of business? Integrated set of activities and assets capable of generating outputs, conducted and managed to provide returns. Returns could be dividend and savings in cost savings. Now, it's very important we are very clear on this definition, okay? Because sometimes, and we will see in the examples that we do, that what we are acquiring may not be actually a business, but may turn out to be an asset acquisition. So what is a business? The definition we talked about, integrated set of activities. Business generally consists of inputs, processes, plus outputs. So for any acquisition that we do, to term that as business, we need to evaluate what is the input, what is the process, and what are the outputs that are going to come out of this business that you're acquiring. So simply put, inputs, so when you're acquiring a company, does it have employees? Does it have assets? Does it have any other machinery, any other assets that would be helped to generate outputs? So those would be typically your inputs. Processes, so what you're acquiring, does it have already existing processes? Resource management process, distribution networks, strategic operation, various other processes, has it already laid down? So the company that you're acquiring, does it have all this? Outputs is nothing but a result of this, which will generate income or result in cost saving. So if you're acquiring a company which is an existing company, a company which is a manufacturing company, it's already generating products which is giving it income. So outputs are those. But the definition says that you need not have all three. If what you're acquiring has inputs and processes, and you are able to use your inputs to generate outputs, then that's fine. If that business does not have outputs at this stage, it is still a combination. And I think this will become more clear when we see some examples. But just for the knowledge, outputs are not mandatorily required for a set of activities to qualify as a business. A classic example could be development stage enterprises, which are just setting up, right? They have not started operating, they are not producing, they are not rendering services, but just setting up. Now the question is, if you acquire a founding company which has just not started production or service rendering activities, is that business combination? That is the question. What you are acquiring, is it business? And we'll see some examples around it. But the thumb rule is, general presumption, that what you're acquiring, if that has goodwill, you're paying much more than the fair values of the business that you're acquiring, there would be a presumption that it's a business combination. But a business need not necessarily have goodwill. So for a matter of fact, and this is where bargain purchase comes in. If you're acquiring, let's say, a SIC unit, right? The fair values of the SIC units, let's say, are 100 crores. You may need not pay 100 crores. Because it is a SIC unit, you may buy it cheap. You may get a good deal. You may buy it at 80 crores. There's no goodwill in that, right? Goodwill would be when you would have paid more than 100 crores. You would have paid 150, the 50 was goodwill. But in this setup, you may actually buy cheap, which does not give rise to goodwill, which is what we talk about as bargain purchase. Hence it says a business, while you've still acquired that SIC unit, it is a business, but just because it does not have goodwill does not mean it is not a business combination. Clear so far? Okay. So we talked about this. Outputs are not required for a set of activities and assets to qualify as a business. Development stage activities without outputs may still be businesses. A business need not include all inputs and processes used in operating that business. If a market participant, if a third person is capable of utilizing the acquired set of activities and assets to produce outputs by integrating the acquired set with its own kind of inputs and processes, as we said, this could still be a business. If the elements that are missing from an acquired set are not present with a market participant, but he can easily acquire or replicate that, it can still be a business. However, in most cases, the set of activities and assets must at least have some inputs and some processes, okay, to be qualified as a business. Again, some factors that we need to look at: is the transferred set assets or a business? Factors include but are not limited to, in a development stage activity, when just a business is set up, the question would be, what you're acquiring, are you going to do business combination or are you going to do asset acquisition accounting? And friends, that from a practical experience we can tell you, it is at times it can be very judgmental. So what do you look at in terms of a development stage activity or a business which is just set up? Some of the ingredients that we need to evaluate: has it begun its planned activities? Has employees intellectual rights and other inputs and processes that could be applied to those inputs? To do that, does that entity have some of these? Is pursuing a plan to produce? So they've not started production, it's a development stage business, but it has laid down a plan to produce. Will be able to obtain access to customers. Determination should be based on whether the integrated set is capable of being conducted and managed as a business by a market participant, a third person. We'll look at some examples on this. So a development stage business. Let's look at this example. Biotech A acquires outstanding shares in Biotech B, a startup with a license for a product candidate. Due to loss of funding, Biotech B has no employees, no other assets. Neither clinical trials nor development are currently performed. However, Biotech A will commence phase 1 clinical tests. Should the acquisition be accounted as a business combination or an asset acquisition? So we've acquired a company, which is a startup company, which has certain laid down, a license. It's not yet started production because of funding, does not have people at this point, has a license. So what the company currently has a license to operate, but it does not have people, etc., that you need to kind of get it started, or clinical trials to start. How would you look at this? How many would believe what this is a business combination or not a business combination? Okay, can we have just show of hands who believe it is not a business combination? Okay, and so why would you believe it is not a business combination? We are acquiring a business, we are acquiring shares of a company.
So I think as you mentioned earlier, probably the processes and output is not there, only...
so they have a license.
We just have
so they have a license which is essential to start a business.
So it is just the
right?
input or the asset that is there and nothing else is there in that particular entity.
Okay. Anybody who thinks differently? Any other different answer? That it is a business? Any thoughts? This is a vital part to start a business. Anybody else? Any other thoughts? So you said it's a license to start a business, while you said that there are no other processes. So let's look at this. And that's where I said sometimes it becomes very tricky. So we said we acquired a company which has a license to start a product, it's a ready business. But does it meet the definition of a business? So what is the inputs? It has license, that's fine. So inputs could be license, people, assets. So it has some inputs, okay? So you need not have all inputs, at least some basic inputs you need to have. So it has inputs, license is ready. But what are the processes? It has nothing laid down to start a business at this point. There is no plan to start something. And outputs obviously is a development stage, you can't expect anything. Hence, this does not become a business combination. What will you do then? What does this become? An asset acquisition. And what is the asset you've acquired? A license. Now think about it. If you had done business combination in this case, you would have ended up doing fair values of these assets. Differences you would have accounted as goodwill. So the acquisition accounting would have kicked in, which would have completely been an erroneous answer. And this is a very practical situation we've seen at times that it can become judgmental. Okay, what are the inputs and processes? Because if you do asset acquisition, there is no goodwill. Whatever you pay is the value of the asset. And that's about it, right? But had you got into a business combination territory, you would have opened up a Pandora's box, the whole disclosures, the whole accounting would have gone for a difference.
But in this case, like, how will we disclose it? Will it be disclosed like as an investment in a particular company? Or
It will be investment, it will say an asset acquisition. I paid so much for an asset of so and so value. So if you look at this example now, maybe we get a little bit more clarity. So same example, Biotech A acquires outstanding shares in Biotech B, A startup with a license for a product candidate. Phase 1 clinical tests are currently performed by the 3 Biotech B's employees, one of whom founded Biotech B and discovered the product candidate. Should now this acquisition, can this meet the definition of business?
Yes.
We all believe it should. Anybody who believes there's still some area of grey? So, sorry? Clinical tests have not started. Okay, anything else?
Clinical tests have started.
So what is the...
Laboratory and all these things. The employees also would be there.
Sure. So now friends, if we see, what are the inputs? You have licenses, you have employees. What are the processes? Operational management processes associated with performance of supervision of the technical tests. So when you're doing tests, obviously now you've laid down a process from which is resulting in those tests. Outputs, none, right? So the set integrated, the business, if we go back, it said integrated set of activities which has inputs, processes, outputs. But even if it has inputs and processes, and if the acquirer is able to generate out of that, it is still a business. This is a classic case where you have an input and a process, but no outputs, but yes, this is a business. So now the accounting will be different. Yeah?
So the laying down the process is only enough, or the test has to be performed?
So are those processes in a good shape where, let's say if you acquire that business, you can just use that processes to start delivering, adding up, let's say, a few more employees. For a classic case, let's say you take over the entire staff, but you don't take over finance and administrative and HR staff. You take over only select employees. Why? Because you have certain people which will help in running this business and generating it. Because it has already laid down a process, you just need to build upon it now and start delivering.
You mean say blueprint of the process?
Blueprint. It could be, process could be like a resource management, how the resource management is. It could be distribution networks, it has a distribution network. So it has entered into contracts with various people, vendors, right? So they have already in place all those things. Now you will just build upon it, start activating that, right? Sorry.
What is if the acquirer is not able to generate the output out of that?
So that is the trick. So the point is, you have to look at a market participant perspective, not from an acquirer perspective. If any market participant could have used this with something that inputs that they have internally to generate an output, that's the definition it looks at. It doesn't say whether the acquirer can generate it. He may have inefficiencies, he may not be able to do that. But any market participant, when it looks at it, how does it look at it? Any third party, will they be able to use this to generate a business? That's the way you look at it. Yes, sir.
I had a question that if we don't take over the 3 employees and we only take over the knowledge they have created till the
Correct.
point of acquisition, then we go back to it's only an asset acquisition.
So that's a very interesting point, and it could be very debatable. So what happens at times, you may not take over people. You may take over the asset, you may take over some processes which they have, knowledge. The question would be, again, no straight answer, but the question would be that, do you have the people who can build upon this? So you have certain ingredients that you have taken over. Can your people now start delivering? If that knowledge, if that documented patents, etc. comes to you, then can you start delivering this when it comes? Or will that be a bottleneck? Because what we are saying, these people have the knowledge. They have basically been running this. Now, if you are able to do that without them as a market participant, then yes, you may reach an answer that it is still a business. But as I said, it needs to be scrutinized for much more detail that really what you are acquiring is business.
Like in case of pharma companies, like they sell some of the brands on this.
Correct. But when you sell some of the brands, it is an asset sale. What are you selling with the brands is the question, right? It's like a license.
But again, you are also doing the processes. Like each and every company has a different kind of processes. Like
Right.
you operate on that.
So what I think the important point would be when you're selling brands, is it only brands, right to use those brands? What else comes with this? What else is coming along? Maybe people are not coming along, but what else? You have to define some processes. What processes are coming along? Because if none is coming, then it's an asset acquisition, right? Okay.
What you are using,
Sure.
your output is restricted by government, and you can't use this process, or your output will not be this.
Right.
Maybe somewhere. So how it will treat it as a business or as a asset?
So again, very specific and subjective. If the processes are ready to be used, and if it's a temporary kind of an embargo, again you have to look at it holistically. Are you able to use it, but because of certain restrictions you are not able to use it? Is it a permanent ban that you can't use some of those? Then obviously it will be of no use for a mining market participant, right? Why would he buy it in the first place? Let's say if there is a restriction, if it's a temporary, a market participant would take a view that is it permanent, then they will now never get into that acquisition, right? It would be more of what is it permanent, is it temporary, that kind of evaluation you'll have to do. Because think about it, when you are buying something, you are making a holistic assessment. If it is not going to be of use, you'll not get into that business. Okay.
I had one concern.
Sorry.
So there's three criteria: inputs, processes, and outputs. The business definition says that it should be there in the entity.
Yeah, correct.
But it nowhere says that the acquirer is acquiring that all the three. So the definition won't be biased with what acquirer is acquiring.
So what the acquirer is acquiring, the whole question is he acquiring a business or is he acquiring assets?
Correct. But
So when we say he's acquiring a business, then it should meet the scrutiny of test saying what are the inputs, what are the processes he's getting is a part of this.
correct. But supposedly, for an example, acquirer is acquiring an entity but not taking the processes because
Sure.
it has already well set process. It is
Perfect.
only taking the input.
Sure.
Still, it is a business combination.
So as we said, if you look at it from a market participant perspective, if the elements that are missing from an acquired set are not present with a market participant, but can easily be replaced, the acquired set still might be a business. So if you're just buying inputs, for instance, a brand, that's the only input. But there is no processes, right? There has to be some process at least to demonstrate that there is, because then it is very difficult to say that it is not an asset acquisition or a business combination. Again, it has to be very case specific, we'll have to look at, but
Processes are there.
correct.
The entity has very set processes.
Correct.
But the acquiring entity has more better processes and it does not want to acquire.
So the question will be if there is none of the processes are acquired, and if we are saying everything is available with the acquiring company, very difficult, again, it will be very subjective or very difficult to say that it will be a business unless we are able to demonstrate that at least something has been acquired. Only asset, then how different would be an asset? I'm buying a brand and then I will use my processes to run those brand or generate income out of that. So then that will not meet the definition of business. Because you have to generate, at least some people have to come in, some part of,
People and brand is coming in.
I agree.
Processes are not coming.
It will be very difficult to say that it will be still a business when no processes are getting in. You're just getting the brand and you will say, I will use entirely my distribution chain, I will use this to generate business. It will be a asset acquisition in all probabilities. Because you have to demonstrate at least some process has to be there.
I think we need to look from a market participant point of view.
Correct.
Not from an acquirer point of view.
Correct.
So if anybody else acquire that business,
Right.
and we will take as this, then that will be business.
Correct.
So from that point of view, this point.
Yeah, but again, it has to be very you have to look at it very carefully. All the guidance is saying that, look, even if you're not taking all processes, you have to, how will you be able to demonstrate that, it is a business? Because how different is it from an asset? If I'm buying brands today, I'm buying patent rights. Can I say that this patent right I will use my factories, I will use to generate that? Yes, I can. But then that is an asset acquisition. You're not, because you're not taking over an integrated set. You're just buying an asset, which you will anyway monetize by using your, abilities and processes. But there has to be a business when you have to take some of those aspects together. Yeah? Okay.
Or could we also say that probably currently the output is not there, but I
So
still have
output is not an issue.
Yeah, so currently the output is not there, but at some point I have the option of kind of getting the output also from that particular acquisition. So in that case, it becomes more like a
So the output is not an issue. So we are saying output need not be present. So we're not getting there actually. We are saying only inputs and some key processes which will be necessary to function. Only inputs, problem. It may be an asset acquisition.
No, my point was like in order to define a business,
Yeah.
like I acquire some asset, I acquire some processes. So when I do a combination of these two, at some point I also have an option of kind of getting the output from those two things itself rather than making the output myself. So that when I get these details, probably defining it as a business becomes more easier.
So
rather
are you
than-
saying you got the inputs and some processes?
Yes.
So that's fine. That's what I'm saying. You may not take all. Output also is not there at this point of time. You may generate the output later on. But the question really what we are debating is only inputs. Can that qualify as a business? Or you need to have some processes to be taken over. The point that we are saying is you need to have some processes. The output are still not there. You may use that process to generate outputs later on.
Yeah,
But
have the option of kind of
that's okay.
generating output later on.
That's fine. So you've got the process ready to, then you may build upon it and start generating outputs. But you've got those processes in there. That's what it says. Inputs and processes will get you to business, even if you're not generating output at this point of time. Yeah? Okay.
Only the input and the customer.
If you acquire only the input and the customer,
Processes I have, better processes I have.
that's the whole question. So, I mean, you're saying customer contracts is what I'm acquiring. Maybe I'm acquiring, so what I'm acquiring? I'm acquiring assets, I'm acquiring some customer contracts. Subjective. One will have to really look at it. How does that fit in? How will you use that to generate, what is the process that you will use to generate business out of that?
Processes, I'm with the same business, so I have
Correct. That's what I'm saying. So the question again would come down, is it only inputs that you're getting? Or are you getting some processes? But if there's no processes you're getting, and you're going to use everything on your own, it may be a bit difficult, but how different is it from an asset acquisition? Because when you acquire an asset, you obviously use your processes to, let's say you acquire a fixed asset or a machinery. You will use your processes to generate that business or output of that machinery. How different is this going to be? That's the question we'll have to answer. Yeah?
I'll give an example for this would be where EY would acquire another accounting firm.
Right.
You would get the people.
Correct.
And you would get the client list.
Correct.
You would do things your way.
Correct.
So then would that be an acquisition of the business?
Yeah.
Or of an asset?
So what we are getting here is the intangibles, that is the customer contracts. What we are getting here is people, right? And in this kind of a business, if that is an essential, because with people you get knowledge, right? So if that is an essential ingredient, you will obviously, then that could still get to it, because you're saying, essentially you're getting the whole customer list, which are contracts, intangibles, but people with knowledge. The knowledge could be something that you could, just build upon and start earning. That will immediately contribute to your business. That may still get you to business, because you are there now ready to start. You've got an accounting firm, you're ready to start generating outputs, right? Not easy, yeah. Right. So what are they buying then? If they are not taking anything, absolutely. So that's what we are saying. There's only the brand rights, the patent rights which you are getting. So how different is it from an asset acquisition? You're saying you give me the patent right. That's what in a nutshell we are saying. By way of acquiring shares, we are saying I'm just taking the patent rights. Rest I will manage. So what you're getting is an asset. That's the patent rights itself will not be able to generate business. You have to integrate it with a lot of processes to start generating. So it is an asset which will be built, processes will need to be added up to get a business driving out of that. Right? There's no distribution network that you're getting. You're not getting it. You're saying I'll use everything of my own. But how different is it from an asset, acquiring a fixed asset from P&G? Right? I mean, that's the difference that we need to get to. Some other company, as in? No, but what are they buying? That's the question. Then, no, brands and the entire distribution chain, contracts, everything. Then obviously, yes, we're getting everything, right? Okay. That's interesting. It's good we discuss this, because as you see, it can be very debatable. And we've seen in practical situations, it gets into very judgmental territory. Okay, again, a scenario where we will look at real estate. Company A acquires land and a vacant building from company B. No processes, other assets or employees are acquired in this transaction. Will this be a business combination? It will not be, right? There's nothing which is coming in. But however, an operating hotel, the hotel's employees, the franchisee agreements, inventory, reservation system, and all back office operations, it will be a business. If they now say, look, I don't want the finance team, I don't want the HR team, I have my own, that's fine. You're getting substantial bit of it, you're getting the entire franchisee agreements, inventory, reservation systems, everything that the way they are working. So, a difference, what could go wrong if you do a business combination versus an asset acquisition? So, goodwill comes in a business, does not come in an asset acquisition, right? Initial measurement, all assets are valued at fair value in a business combination. You have to fair value all assets and liabilities, whether existing on the balance sheet or hidden, like an intangible you have to bring up on the balance sheet. So all have to be fair valued in a business combination. Okay? While in asset acquisition, whatever price that you're paying will get allocated to the assets. Directly attributable, and this is very important, directly attributable transaction costs, let's say due diligence, legal, whatever transaction costs have been incurred, get expensed out in a business combination, not allowed to be capitalized. And this was a very big change which happened in this IFRS, when IFRS changed a couple of years back, where earlier it was allowed to be capitalized, but then they said in the new IFRSs which came up, transaction cost to be expensed out. While in an asset situation, if I acquire an asset, I can capitalize all direct costs. So even transaction costs get capitalized. Again, deferred tax comes into play, and we'll deal with when we get to taxes. But in a business combination, you will also have deferred tax coming in. Any idea why there would be a deferred tax accounting that will happen on a business combination? Any wild thoughts?
The fixed asset values you may not be able to take.
So what are you doing? You're doing a fair valuation of all assets. Let's say your fixed assets was in the books of the acquiree was 100 rupees. You are saying it is worth 150. So you are recording at 150, but the tax base doesn't change. The tax will still consider at 100 only. They will not allow you the additional benefit. So this gives rise to a difference, right? Hence, you will record a deferred tax adjustment on the acquisition date. Disclosures, significant disclosures in a business combination, and we'll get to that. In an asset acquisition, there will be not too many disclosures. Just this example talks about it. So the price paid is 1,000. Transaction cost expensed, capitalized 200. Fair values, again, it lays down what are the fair values, 300, 600, and this is just the example which gives the earlier slide we talked about. So you'll see a deferred tax coming in because 900 minus 700. So the asset price has gone up to 900 from the original price that was standing in the books. The only assets are buildings, the book value is 7, fair value is 900. So on that spike of 200, you've recorded a deferred tax adjustment.
So in case of business combination, does the company that is being acquired, does it lose its legal status? And
No, so it depends. So it doesn't. So you're acquiring shares. Again, this if you're not merging those companies, then it continues in the standalone books. This business combination accounting will happen in the consolidation level. So when you consolidate that company, you will do the acquisition accounting. What we are saying is you acquired shares in the company, so the existence of that company is still continuing. So in the standalone books, you don't record the fair values. You will record whatever values are standing in those books on a standalone basis. But when you consolidate, that is where all these adjustments will start happening. You will have to do a fair valuation. It is at a consolidated level, the adjustments happen. Because standalone, nothing has changed.
so in standalone, it
Because there is the concept of push down, which is there under US GAAP, where the fair values get pushed down to the standalone books. That is still not there. So you will continue in the standalone books as per the carrying values of the acquiree, but when you consolidate, all these adjustments come in.
So on a standalone basis, for the acquirer, it will be just an investment in the other company.
Yeah, absolutely. Investments and the carrying values in the books of the acquiree as is, like the way they were, as if nothing has changed. The moment you consolidate, all these adjustments come in.
The only case where it will be there is in case of amalgamation, where
Yeah.
you do AS 14, where the other entity loses its identity and gets merged. Or under when you acquire a business which is under AS 10, which we cover, everything will get covered by this principle. So whenever then business combination accounting is only from the point of view of acquirer. So if it's an equity purchase, amalgamation, a division purchase, everything gets subjected to this principle. So under Indian GAAP, we have 3 different standards. We have only one standard here. Okay. So in standalone books, when it will really be relevant, when in standalone books level, you are acquiring a division which gets subsumed in you. Then you are an acquirer. Okay. In that standalone books, you will see the acquisition accounting or this business combination accounting coming into picture. But if you acquire just shares, then at standalone books, you are not acquiring any business or other thing. You are acquiring only investment. Whereas in CFS, you will say, I have made an acquisition of an company, which is a business. Then at CFS value, the acquisition accounting will get triggered. So it's just the way at which level the acquisition is actually happening.
Okay.
Rajiv, could you also elaborate on this push down goodwill?
Yeah, so the concept is now a 100 rupee asset in the standalone books. So you acquired, let's say as you take HUL acquired PNG. Now, so they have acquired the shares. So PNG existence continues in this as a standalone level. They're not been amalgamated right now, separate 2 entities. So you have paid, let's say for the 100 rupee assets, you have paid 150. for that particular, the fair value of that asset is 150. So when you consolidate, you're going to record 150 in the consolidated financials. But in the standalone, it will stand at 100 rupees in the books of PNG. The acquiree, I am the acquirer, I'm acquiring PNG, so in that books it's still 100. So what the guidance under US GAAP under specific situation says, that you may have to push down, change the values of the standalone, make it 150. So instead of doing the adjustments in consolidation, you do it in the standalone level itself. So you push down the values in the standalone books itself. So you change the values in the standalone books. That's called push down accounting.
The asset will then be at
150. That's called push down, where you're doing it consolidated, do it at the standalone itself to change the values there itself.
So at console level, there will be no goodwill then.
Consolidated because you already accounted everything here. So they're saying just push down the adjustments in the standalone rather than do it in console. So that concept is not there under IFRS and Ind As. Sorry? So that adjustments will happen in the standalone books itself. Yeah, so whatever adjustments you're doing in console, you do that in the standalone. So of the acquiree. Because what you're saying, the book values of the acquiree are not worth 100, they are worth 150. That 150 you are recording only at a consolidated level. But actually when it is worth 150, might as well record at 150.
So it's a fair valuation.
Fair valuation. So all we are saying, the consolidated adjustments get pushed down to the standalone acquiree books itself.
But aren't we then just creating goodwill in the books of the
Yeah, so that's what I'm saying. Let's not get into that.
Okay.
That's it's not a part of IFRS and Ind As. Under US GAAP, there are specific situations where you can do that.
So
Okay.
you can create goodwill in your books.
Yeah, so that's where you can do that under US GAAP. So I didn't want to deviate too much into that. Okay, it's not relevant from an IFRS, so we will continue doing at a consolidated.